morning, ladies and gentlemen, and how do you do today? I'm Seth Julian, your host for this morning's morning coffee briefing. We're looking at the S&P 500, the index, the largest, the broadest, well, not the broadest, but certainly the most indicative index of U.S. corporate health there is. And we're doing so today because today is the kickoff of earnings season, the quarterly report of public corporations, which tends to drive markets slightly wacky, myself included. The reason is quite simple. There's a lot of trading that goes around these reports. There's an easy trade that we've talked about many times, and sometimes can be profitable, other times less reliable. But it's fairly reliable trade in that you look at the trend of the stock of the last quarter. If the expectations of the report are approximately in line with that expectation, in other words, the stock went up for the last quarter, expectations are positive, you would buy the stock in anticipation of that positive report. When the positive and if the report comes out positive, oftentimes there's a pop in that very direction. Not all the time, but it's fairly reliable trade. I myself personally only trade the Q4 reports, which come out in Q1 of the following year, because in my opinion they're the only ones that have any real value. But that's neither here nor there what I do. The reason, what I do want to say though is this: we are looking, this is of course the beginning of the year when the inflation that kicks in from this, by the way, of course, just to review for those of you who haven't had this permanently imprinted on their consciousness, this is the end of Q1 2020 where the plague strikes. This is where government goosing and a very, very serious realignment in the socioeconomic patterns of life drives corporate earnings way, way up. And once the inflation from that starts to kick in along with the Ukrainian war, we have a decline. Now, this decline is not a financial decline. This is a standard economic boom-bust cycle, nothing to worry about in the sense that it's going to be long-lasting or particularly deep like the financial crisis. But the question is this: now, have we bottomed out? The commentary ad is constantly asking itself, have we hit the bottom? Is it going to return its climb? And we may get some hints about that, and we're definitely going to get some hints about that come this reporting season. Because regardless of whether corporate profits have held up or whether banks have started to make larger loan loss provisions, or whether they've actually even booked those loan non-repayment expenses. The question is, what do they think about the future? Does it continue to look bleak, or are they anticipating an uptick? That's what we're really looking for. So earnings report season gets underway today with J.P. Morgan, then followed by the big banks this week, and Bank of America, Goldman Sachs, Wells Fargo, etc. And Citi and Wells report tomorrow. Goldman and BOA report on Monday, and then it starts the same, main semantic cycle again and again and again. But what we're looking for is not so much whether they beat the estimate or don't beat the estimate. We're looking at what they are anticipating for the future, and whether this broad decline in the stock market is over and likely to reverse or continue down. So, ladies and gentlemen, that's our earnings report update for the beginning of the session. I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.